Let's move on now to the income statement for the last 2 years of the campus bookstore. The first thing that we observe is that sales have been increasing, whereas the net profit has been decreasing. So yes, we have sales growth, but this growth is not very profitable. If you want to be more precise, you will see that sales growth has been around 17%, whereas there's been a negative growth of 15% in the net income. So our margins have gone down. So let's start examining the income statement by the top line, revenues. What would be the questions that these numbers would raise? First, why did we have this increase? Is it that we have new customers, so new markets, or we have maybe new products that are selling very well? Is it a matter of quantity or price? Maybe we are selling at a higher price and this is why the total revenues have gone up. Or maybe just that we decrease our prices and we are selling more quantity, so the overall amount of sales is bigger. Another question might be, are we better at differentiating our products from the ones of our competitors? Are we giving a better service and maybe that's why we get so many customers? Or it's just that we are a low-cost competitor and therefore people come to us because we are cheaper than the others? So these are the kind of questions that after examining the numbers, you can ask the managers in the company. If we continue down the income statement, we get to the gross margin. The gross margin is sales minus the cost of goods sold. And what we see here is that there's been a decrease in this gross margin. So why did that happen? Is it that we have now higher purchase cost? Despite the fact that we are purchasing more from our suppliers, is it possible that they don't give us discounts? Maybe we have changed the product mix and now we are selling products with less margin? Or it's just that we are selling the books at a lower selling price and therefore our margins are lower? All of these are questions that we should ask again to the managers of the company. The only thing that we observe here is that the margins have gone down. If we continue down the income statement, we get to the operating profit. We see here that there's been a decrease in the margin of the operating profit over sales. Part of it is because of the gross margin already. But also here we observe other things. For example, there is a one-time loss that we have in year X2 related to the sale of an asset. Well, that's something that is not going to happen every year. Therefore, this is something that, if we look at the future, is something that we are going to adjust. It's a loss that we're not going to have again. So it's always important to ask which of the costs are recurring, so they happen every year, and which of them are just a one-time thing. Other questions that you may have here. What is the proportion of fixed and variable costs? So the more fixed costs we have, the higher the operating leverage of the company. And so by increasing sales, if fixed costs remain the same, margins increase, get better. Then we can ask also about the inflation of selling general administrative expenses. We actually see for the year X2 that the salaries and utilities have increased from 30,000 to 37,000. Also the rent that Christine is paying has increased in the second year. So all of these are relevant things that need to be studied in order to explain the change in the margins of the company. If we continue down the income statement, you'll see the profit before taxes. And so part of it is explained by the interest cost. And the interest cost will depend on the level of debt that we have. So that's another question, something that we can see actually on the balance sheet, the level of debt that we have. And what is the interest that we are paying for this debt? This is a question we can ask as well. Are we getting new loans that are a little bit more expensive maybe? In this case, as you see, we continue the same as in the previous year. So there is no cause of concern. Finally, we go to the bottom line. We see that overall, the margin of the company has gone down. And so the return on sales, for example, for the year X2 is going to be 3.4%. And so the return on sales has decreased from 4.7 year X1 to 3.2 in year X2. Another way to gauge how profitable the company is by comparing the profits, remember, to the investment that the shareholders have made in the company. This is called the return on equity. So we divide the net profit for the year, which is the amount that belongs to the shareholders, by the total owner's equity in the beginning of the year. The return on equity has decreased from almost 17% to 12%. So that's a substantial decrease in the return on equity. Great. Now that we have clear in mind that the company is profitable, but that the margins have been going down despite the fact that the company is growing its sales, let's continue with the analysis of cash. Is the company liquid? Are we generating liquidity? The first thing that we see is that in year X1 there was a big decrease in cash, and year X2 there's been a slight increase in cash of 1,000. If we start by the cash flow of operations, we see that last year there was a decrease in the cash flow from operations, the first year of operations of the company, remember? That means that our payments to suppliers, payments of selling, general, administrative expenses, the rent, etc., were actually higher than the cash we were collecting from the customers. So this is the cash that is coming from the operations of the company. Despite the fact that we were profitable, remember. So last year we were profitable, and yet the cash flow from operations was negative. Now, in the second year, though, we have started to collect cash, to have positive cash flow from operations. Why? Because now we are increasing sales, collecting more from customers. Remember that many of our customers pay in cash, so that's good news. Now, in the second year, we have started to have a positive cash flow from operations. And the main reason for this is not that we have less payments, because actually we have more payments, as you see here, but the reason is that we have more sales. And as you know, most of the sales are collected in cash, because they are done to individual customers. If we continue with the cash flow from investing, we see that in both years it's negative. This is normal because this is a company that is starting the new business, and therefore it has a lot of investments to make, in this case in furniture and equipment. So in the first year is minus 10,000, remember that was the payment to the suppliers of furniture and equipment. And in the second year it's been also negative because of the purchase of new furniture and equipment. But also we have to say that part of this decrease has to do with the investment in the Apple stock. So that's something that is totally discretionary, and therefore at any point in time Christina can sell this investment and get the cash back. So I wouldn't be too concerned about this minus 15,000. Finally, we see that all of this explains the ending balance that we have, and that we have plenty of cash to continue with our operations without any problem. Now that we have analyzed the Campus Bookstore financial statements, I think that you are very well equipped to read and understand the financial statements of a real big corporation. So in the next video, we are going to analyze the financial statements of Inditex Group, the owner of Zara.